Hey everyone, this is Morris Galvez, your finance spreader. Just a quick little update of what's going on with the markets, especially this week that we saw these wild swings in the markets. From the beginning of the week, we saw the stock market pretty much selling off on the news that we may be seeing some issues with England. Then all of a sudden, England fixed their issues because they got rid of their prime minister. And now we're seeing them back to recovery. And the same thing is pretty much happening in America. We have a lot of issues with our bond market, we have a lot of issues with the stock market, and we are gonna have some issues, especially starting next year. I believe we are barely getting into the beginning of this recession. We are gonna see more companies start laying off people. We are gonna see more companies cutting off some of their spending and pretty much trying to play it safe when it comes to where they're investing their money for their projects. And today we're just gonna be looking at a very quick little setup on what the markets are pretty much thinking of doing and why are we seeing this huge uptrend in the stock market. What I want to look at is Market Watch. One is a very good website for when you want to check information about the stock market and what's going on with the economy. They give really good insight of some of their and the best thing is that they're free as well. We're starting to see the idea that the Federal Reserve is gonna begin a pivot. Now, what is a pivot? A pivot is when you start doing the opposite of what you say you're gonna do. So pretty much the Fed has been saying they're gonna keep on raising rates. They're gonna start doing quantitative tightening and get rid of the cash that's in the markets. Well, they're gonna start doing the opposite. That's the idea. So they're gonna start lowering rates. They're gonna start maybe doing some quantitative easing, meaning giving out some money to the banks and the industries and maybe to people so that they can stimulate the economy. Why? Because we're seeing the economy starting to slow down at a very fast pace. Home buyers are dropping very fast. The bond market and stock market are starting to hit levels that we did not expect to see anytime in the near future. So we're going through a mini crash, if you can call it that. So yeah, we're starting to see there's a possibility that we could have a smaller rate hike in November, as well as maybe a pause that's gonna start next year, maybe the beginning of 2023, January, February, of no more rate hikes. Why? Because we're starting to get to the tipping point. Banks don't have enough liquidity to give out loans. Companies don't have enough money to hire workers. Customers, people that are buying the products, don't have enough cash to spend. And us, we don't have enough cash to spend on a microphone or a computer or equipment for recording. So the economy is actually slowing down. And that's what they're trying to avoid. They're trying to avoid a hard landing, which is when the economy crashes to a certain level that we hit a recession, a very deep recession, something that is not gonna last just 3-4 months. It's gonna last at least a year, maybe longer. We already saw Elon Musk saying that the recession could hit and it won't end until 2024. So that's another 12 months of pain that we're gonna see in the market. And if things don't change, we might start seeing that not only just in crypto like in Bitcoin, but also in the SPY, which is the S&P 500 ETF, which tracks the top 500 companies in the United States. And I want to show you just two metrics about what is happening with the stock market just now. And there are these two lines here. This is a 200-day moving average, and this is a 200-week moving average. If I show what the channel that we're going through is happening, we are pretty much in a descending, broadening wedge. And what may happen, and at least what will happen, is we'll go up again, touch this, maybe when this line starts coming closer, we'll touch it again, a lower high, and start coming back down. Of course, that depends on what the Federal Reserve does. If the Federal Reserve pivots, maybe this won't be the limit anymore. Maybe this changes to an actual bull market. But it all depends on the Fed. The Fed has to say they're gonna stop raising rates and they're gonna pause and maybe even lower rates earlier then they say that they were gonna lower rates, which is at the end of 2023. Most likely, if things turn out to be bad, maybe the Fed pivots and we start seeing a decrease in rates the middle of the year to the end of the year. So it wouldn't make a big difference, but if things really go bad, they're gonna have to start cranking the printing machine and print out more dollars and give it out to people because the economy is crashing. This is another chart that I want to show you actually. As we can see here in this chart, this orange line is the Federal Reserve's funds rate. This is the speed at which the Federal Reserve is raising rates. Now this green line here, which is hitting at 4.2, is the 10-year bond yield. And what pretty much happens every single time is the Fed tries to follow this line in order to make their economic policy. Now, as you can see here, in 2008, when we had the big crash, of course, rates also went up almost to 5%, and the Fed had to catch up. They were at a very low. That's when we had quantitative easing. In 2007, when everything was going fine, we had low rates. Everybody was getting loans for homes, cars. Everybody was buying things. And what's happening now is that, well, they caused inflation to go up. We had the housing bubble, and pretty much they had to reverse course and pivot and go from a quantitative easing kind of scenario to a quantitative tightening. Oh, the way you guys haven't seen, my kid is right here napping with me, just chilling. Little bubble. And yeah, so what is pretty much happening now is that they're gonna do the same thing. They're gonna have to catch up to this green line, and they're gonna have to stay there for a little bit. On average, they stay there for almost a year. As we can see here, they stayed from beginning of July of 2006 to the end of July 2007. Yeah, basically 1 year of tightening economic policy in order to avoid the economy from crashing. But of course, that caused the stock market to crash, housing market to crash, the bond market to crash, and it caused big pandemonium. And we're gonna be seeing the same thing here as well. Once this line starts crossing this line, that's basically where the Federal Reserve will say, okay, you know what? We've hiked enough. Now we gotta hold this for at least a few months. Check how the markets respond to this new rate hike and how the housing market responds, the bond market responds, the stock market responds, and we'll decide whether when to start the economic easing, bring down rates again. That moment when they say, oh, we're bringing down rates, that will be the moment when you want to buy the dip. That will be the moment when you want to buy homes, when you want to go crazy and start investing in everything you can: bonds, ETFs, stocks, real estate, cryptocurrencies, because that's going to be the moment where we start seeing everything start going up again. That's basically what happens during economic crisis and economic scenarios like we see here. We'll start seeing the opposite happen. Instead of stocks coming down like they did here and like they did in 2000, we'll start seeing stuff coming back up once they go down. So the moment they start going down, the stock market will start a slow recovery. It wouldn't be like, oh, we're gonna go back to 2020 numbers or 2021 numbers. No, it will be very slow. We'll start gradually going up again, and maybe we could get stuck here depending on how the economy responds to the rate hikes a little bit longer, but it all depends on that. That's pretty much all I wanted to show you, and like quick glance on what's going on with the markets and very quick little update. And that's pretty much it. I'll see you guys on another talk. Finance Predator out.